Some conflicting reports about Greece keeping European markets in check. I'm joined by Burns McKinney, portfolio manager at NFJ Investments. Nice to see you here in New York.
Thank you very much. It's good to be here.
So we had a situation Wednesday where stocks were rallying. There were reports that Greece was getting closer. We've seen this picture before, I guess. How does what's happening there moment to moment affect the way you're looking at markets in Europe?
Well, I think for starters, and it does appear to us that Greece is moving forward with respect to coming up with a deal with their creditors as far as cutting their budget and enacting some structural reforms. And so in the near term, things probably look like they will, in fact, get the funding they need. Looking out a little bit longer term, though, I think that some of the concerns that we have about what's going on in Greece are the fact that although a lot of investors are prone to suggest, well, Greece only makes up about less than 2% of European GDP, so maybe it can be overlooked. I think one of the catches is that it's not so much the size of GDP, but the fact that oftentimes it's the leading edge of trends to what might happen throughout the rest of Mediterranean Europe and places like Italy, like Spain. And a concern is it's that not that we by any means think that a Greek exit is likely, but rather that at the very least that's no longer properly discounted in the markets if you look at sovereign bond yields throughout Mediterranean and Europe. And so it's something that we believe the markets probably have overlooked a bit more than they should.
So it makes me wonder about what's happening with the markets overall, because stocks have had a pretty good rally. There's been low interest rates, all this stimulus. Are the markets ahead of themselves? Has this rally been overdone?
If you're a U.S. investor, there are still good values to be had in Europe. On a cyclically adjusted basis, European stocks still trade at nearly historic discounts to those in the United States. That's probably an argument to say that equities over here have probably gotten a little bit more overdone. You can still get, I think on average, 2.5% to 3% dividend yields in Europe. And so relative to the United States, there are opportunities. But if you look at European stocks now within the perspective of an international portfolio, ex-US, they've probably gotten a little bit ahead of themselves compared to places like developed Asia or even the emerging markets.
In terms of actual holdings, what are the best sectors to be in light of this concern that maybe the market's ahead of itself? There are still some problems down the road.
I think that probably one of the first places to look would be the financial services sector. It's a place where valuations are still, they haven't rallied back to their historical levels. You still can get discounts to where they traditionally have traded. And the fact that a lot of the banks throughout Europe and financial services firms have really finally gotten about cleaning up their balance sheet. And as such, there's a lot of higher quality assets that should soon be flowing through the financial services sector.
What else beyond financial services?
We believe that within a lot of the integrated oils, some of the energy space can look fairly interesting. I think that in the near term, it wouldn't be surprising if we saw oil prices start to maybe retrace some of the recent gains. But if investors look at longer term, the best cure for low prices is low prices. And with the U.S. shale producers really, by and large, replacing OPEC as the swing producers of oil, one needs to use a little bit different playbook for these players because they have very steep decline curves, which means if you don't have firms consistently punching straws in the ground and drilling, then you can see a fairly rapid supply response. And we've seen rig counts come down very sharply. And so as such, if investors can look out 2 to 3 years, you have an opportunity to take advantage of, we at NFJ like dividend-paying stocks. That's one of the places where the dividends have in fact been very resilient.
Give me your top 3 favorite stocks then in either of these sectors we talked about.
Going through those, a couple of financial services firms we've been buying lately, Nordea Bank out of Stockholm, Sweden is one that looks fairly interesting to us. It's right now trading about 12 times earnings, has a dividend yield of over 5%. Zurich Insurance is another one that looks pretty good. It's trading at just really not much above its book value. It has a dividend yield that's well in excess of a lot of the European insurers, despite the fact they've proven themselves to be a very disciplined underwriter. In the energy sector, I think Royal Dutch Shell is one that it certainly looks interesting to us. Right now, if you can get Royal Dutch at about 14 times earnings, you'd pay 20 times earnings for ExxonMobil. You're getting, again, about a 6% dividend yield nearly. And the recent transaction of BG Group is something that really, it solves a lot of challenges they have faced. They have good reserve replacement rates. I think that going back historically, when you've seen oil prices trough, a lot of the most successful integrated oil companies have been those that have consolidated at the bottom. Names like Exxon and Mobil or Chevron Texaco back around the year 1999 through 2001. And Royal Dutch has made some similar moves in recent months.
We'll end it there. Burns McKinney, nice to have you here.
Thank you very much. I
Thanks.
appreciate the opportunity.
I'm Rhonda Schaffler for The Street.